Hello everyone. On behalf of T-Consult, I would like to welcome you to this webinar. My name's Kirsty and I'll be your online host today. In a few moments, we will be welcoming our presenter, Ross McGill. Ross will be discussing the changes we can expect in the new QI agreement, which is due to come into effect on the 1st of January 2023. We're also joined by our affiliate, Amanda Hazoo, who will be translating for us today. Please note that we do not accept responsibility for any action that you choose to take or not take as a result of participating in this webinar. Thank you for your attention. I'll now hand over to Ross to begin the course. So over to you, Ross.
Good afternoon, everyone, and welcome again from T-Consult. I'm very happy to be presenting this webinar today. It's just a brief webinar, about half an hour long. For those of you who don't know about T-Consult, we're a UK-based consultancy. We have 23 years of experience in US withholding tax. We're active in 20 countries, including in Taiwan, in Singapore, and in Hong Kong. And we've also written the book on the subject. This is the second edition that you can see on the screen. And if you'd like to buy that, you can get that from Amazon, or you can get it from the publisher, Palgrave Macmillan. So what we want to talk about today is the new QI agreement. And as Kirsty mentioned, it comes into effect on the 1st of January, 2023. The changes that are in that agreement will be automatically applied to all 5,000 existing QIs around the world at the same time. The biggest change in the QI agreement is the addition of a new set of regulations called Section 1446F. We'll talk about those more in a moment. The draft changes have already been announced in a notice issued earlier this year by the IRS. That was Notice 2022-23. The final version of the QI agreement will be published by the IRS as a revenue procedure. So what's changing? Well, the current QI agreement provides for Section 1446A, which is distributions of income from US publicly traded partnerships, treated for withholding and reporting under the normal Chapter 3 and Chapter 4 rules. What's new is that from January the 1st, 2023, you must apply a new 10% withholding tax on the amount realized on transfers of PTP holdings when the transferee, that's the buyer of the PTP, is not a US person. You apply the 10% withholding unless there is an exception to apply, or if the PTP has issued a qualified notice. The tax is paid by the transferor or their broker. The new QI agreement will also provide updates to the rules for documenting, withholding, and reporting PTP amounts. Refund procedures where the tax is over-withheld by a financial institution. And because the IRS wants to make sure that you stick to the rules, they will also be changing the definitions of an event of default and a material failure. These are the two most common things that allow a qualified intermediary to be terminated from the program. So let me just start by making sure we're all speaking the same language, so to speak. When I talk about a transferor, I'm talking about the person who's selling the PTP interest. A transferee is the person who is buying the PTP interest. When the IRS talks about the amount realized on a sale of a PTP interest, what they mean is the amount of gross proceeds. And gross proceeds is simply the amount that a seller receives from the sale of an asset. So this is not about the difference between how much I bought the asset for and how much I sold the asset for. It's the amount from the sale of the asset. The other term that I used was qualified notice. This is a notice that's published by a PTP to explain the tax treatment of any distribution it's making and whether there are any exceptions or modifications to the tax treatment. So what we'll cover in the rest of this webinar are four things. First, what is a publicly traded partnership? How to determine if you're being affected by it? What choices do you have as a financial institution? And what you can and should do. So let's start with what is a PTP? A publicly traded partnership is a type of limited partnership that's managed by two or more general partners. That can include individuals, corporations, or even other partnerships. The partnership is capitalized by the limited partners. In other words, they provide the capital, but they have no management role in the partnership itself. The partnership has interests that are also traded on established securities markets or are readily tradable on a secondary market. In other words, the PTP will be investing money in its own right anyway by buying and selling securities. It's interesting to note that if you want to spot a PTP security, it often has the letters LLP at the end of the security's name. That's not always true, but it is a good sign. So the next question is, are you affected? Well, the first question really is, how do you identify a PTP? The most common two ways to do this are to ask your upstream counterparty for a list of PTPs that are available to your clients. The second is to visit the Depository Trust Company's website. The DTC is the United States Central Securities Depository. PTPs are required to send qualified notices to DTC. You may need to register with DTC to be able to access those qualified notices. Remember, the purpose of the qualified notice is to determine any reduction in taxation or an exemption that might apply. Finally, of course, you can always analyze the prospectus of the security of a PTP to see if it can receive income that's effectively connected to a US trade or business. This is important because the amount of tax and the rate of that tax can be affected by the amount of a PTP's accrued effectively connected income. So, what are your operating model choices? Excuse me. There is a new option for 1446F operations. Now, if you remember, the capacity in which you operate with your counterparties is communicated using a US form called a W8IMY and a withholding statement. The IRS updated the W8IMY in October 2021 to include selection options for 1446F. What this means is that you can act differently for 1446F than you do for chapters 3 and 4. So, for example, you may be a withholding QI under chapter 3 and chapter 4, but that does not mean that you have to be a withholding QI for 1446F transactions. In fact, there is a new option available called disclosing QI. Now, you will know probably that most qualified intermediaries do not disclose their clients when receiving income. They operate using pooled tax rate accounts, omnibus accounts, in other words. However, under 1446F, you can choose to disclose clients if they are transferors of PTPs so that your counterparty withholds the tax. If you intend to do that disclosure, you'll need to provide a withholding statement that lists each recipient that's a transferor and the tax rate that needs to apply. So let's take a look at the options that are available. Withholding QI, the new disclosing QI, and non-disclosing QI. You'll notice that I put a piece of text on the last two of these. The disclosing QI is similar to a non-qualified intermediary, and a non-disclosing QI is similar to a non-withholding QI, but we'll talk about that in a moment. If you choose to be a withholding QI for the purpose of 1446F, that's a choice that you can make. It does not affect whatever decision you've made about the capacity that you act in for Chapter 3 and Chapter 4. That would normally be typically for dividends and portfolio interest. All you would need to do is complete line 15B on the October 2021 Form W8IMY and provide an updated withholding statement so that your counterparty pays you gross. You are then responsible for collecting the tax and paying the tax to the US Treasury. If you choose to be a disclosing QI for the purpose of 1446F, you'll be providing a W8IMY, but the withholding statement that you provide will be at payee level. In other words, you'll identify each transferor that received a payment with respect to a PTP. Once you've provided that withholding statement and the associated W8 forms and W9 forms to your counterparty, it's now your counterparty that withholds the tax. You don't have any 1042S reporting to do because you've disclosed your clients for the purpose of 1446F to your counterparty. So they take on the 1042S reporting obligation. The third option is to be a non-disclosing qualified intermediary. This means that you'll be providing a pooled withholding statement to your upstream counterparty. So you won't be identifying each transferor of a PTP. But what that means is that you now must calculate how to withhold based on the client documentation that you have. Because you have not disclosed who your clients are to your counterparty, that means that you do have to report PTP income and tax withheld on Form 1042S. What do you need to do? The first thing that you're going to need to do is to document your account holders where they trade PTPs. And there are some important changes here. You need to have a valid W8 or W9. If your client trades PTPs and could be a transferor, in other words, they're a seller, then they will need to have a valid US tax identification number on the W8. It's not enough for that valid US TIN to be sitting in your KYC records. It has to be on the form. If your client happens to be another financial institution, you'll need a W8IMY using the October 2021 revision so that you can determine what they're doing and how they are acting down the chain of payment from you. So just so that we're all clear, with respect to publicly traded partnership distributions, such as dividends, the tax rate is 37% if the recipient is an individual and 21% if the recipient is an entity. For a PTP, gross proceeds, the tax is 10%, as I said earlier. But you will need to check for exceptions and any qualified notices that might change the proportion of the payment that is taxable. Now, you'll be pleased to hear that I'm not going to go through the diagram on the right-hand side of this slide in detail, but we will be posting a recording of this webinar to YouTube after the webinar ends. So you'll be able to download the slides and look at the slide in detail. The first thing to do for withholding under Section 1446F is to establish if there was an amount realized. So first of all, was there a gain? And if there was a gain, then how much was the sale price? The second thing to do is to check whether any exception applies. So first, check if there was a qualified notice that states that an exception or a modification to the tax rate or the proportion of the payment that should be taxed at 10% applies. The second is to check if there is any backup withholding that needs to apply. So I spoke earlier about the 10% tax rate applies to non-US persons. If the transferor is a US account holder, you should have a W-9 on file for that account holder. But if you don't have a US tax ID number, or that tax ID number does not match the IRS database, or if the US person has told you on their W-9 that they're subject to backup withholding, then the exception does not apply, and you would have to tax at 24% backup withholding. And finally, you should check to see on the W-8 whether your client has made a special rate claim to reduce the rate of tax. There are some tax treaties which will allow a special rate to be claimed, and that will need to be put onto the W-8. One important thing to note here, you cannot apply an exception to withholding on income received by a client of an NQI. So if you have customers who are also financial institutions, you should also have a W-8 IMY from them. If on that W-8 IMY, they are telling you that they are going to disclose their clients to you, even for the purpose of 1446F, you cannot apply any exceptions. So when you receive their W-8s and their withholding statements, you can't apply any exceptions to the 10% withholding for any client of a non-qualified intermediary, even if that client has been disclosed to you. So we've talked about documentation, we've talked about withholding, and now we come to reporting. This only applies to withholding and non-disclosing QIs. You should obviously use the form 1042S, and you should report PTP distributions, which would normally be under section 1446A as income code 27. PTP gross proceeds under 1446F have to be reported separately, and they would be reported using income code 57. Whilst you can do 1042S reporting on a pooled basis if you're a qualified intermediary, if your client is receiving PTP gross proceeds and they are a grantor trust or another partnership, then they must receive a separate 1042S and be reported separately to the IRS. Other points that you should note. Some financial institutions are taking the approach that they will just withhold 10% of gross proceeds across the board and refund clients later if it's found that they over-withheld because there was an exception, for example. There are three methods for a qualified intermediary to refund a client, one of which is called the collective refund, and that's the most popular method. You cannot use the collective refund method for PTP transactions. The definitions of some events of default and material failures have been updated for reference to PTP income. This is important because every 3 years, your financial institution will be audited by a competent and independent party to make sure that you have met the terms of the QI agreement. The IRS has included changes to the definition of event of default and material failure, which now include PTP failures. And remember, if your client is not an American and holds PTP interests, they will need a US tax ID number on their W-8. The rules for validating a W-8 mean that if you have a TIN, a US TIN on a W-8, you must have a reason from your client. Clearly, a valid reason is because we trade PTPs, but you will need to change your validation processes to make sure they take account of that. So how is the industry reacting? Because the notice about 1446F and the information about it have been available for some time now. We have been asked on many occasions by clients and prospective clients what our views are about 1446F. We ran a poll earlier this month to ask financial institutions what they plan to do about 1446F. The results are here. 55%, over half of all the financial institutions that responded to our poll said that from January the 1st, they were going to prohibit trading in PTPs. Of course, if you do that, it means there cannot be any realized amount, and therefore the issue of 10% withholding goes away. 20% of the people we asked said they were going to adopt withholding QI status. Now, in most cases, they are already withholding QIs, so they already receive all income gross. They decide how much tax is going to be withheld, and they pay the US Treasury. 10% of the people we asked are going to adopt disclosing QI status, and that's the new status. So we don't know how that's going to work out. It should mean a change to the way in which withholding statements are structured. 15%, quite an important amount, just don't have any strategy at all for how they're going to deal with PTP interests. So I think that's quite an interesting response from the industry. And certainly those who are intending to prohibit trading in PTPs will need to make sure that any clients that currently trade or hold PTPs sell those PTPs before January the 1st, so that their client base of the financial institution is completely clear of any PTP interests. In summary, decide if you want to continue offering PTP products because 1446F regulations come into force on January the 1st. Some institutions are planning to withdraw from the PT market to avoid those rules. However, if you do intend to allow trading in PTPs, the second thing you must do is choose your operating model. To do that, you must consult your upstream counterparty and find out which operating model they support. As many of you will have found before, you may choose to want to act in one particular way, but when you try and tell your counterparty, they've taken a commercial decision that they may or may not support the way in which you want to work. So it's absolutely vital that you talk to your upstream counterparty and ask them, what kinds of operating model will you support for 1446F? Finally, if you're a qualified intermediary, you must make sure that once you've made your decision, that you update your compliance program, policies and procedures, update your systems so that they can track PTPs and the amounts realized so that you can properly withhold the 10%. And then you must make sure that you train staff to reflect your decisions on those procedures. Remember, a compliance program is a contractual obligation of a qualified intermediary. You must have one, and it's the responsible officer's duty to keep it up to date. So for those of you who are interested, we did write a briefing paper on 1446F and the new QI agreement earlier this year. You can also go to the internet and get Notice 2022-23, which will give you much more information. And of course, you can wait for the new QI agreement to come out as a revenue procedure, probably in January. Sometimes the IRS will issue it slightly before January the 1st, but we don't know when that document is going to come out. So that concludes the webinar for today. Thank you very much for your attention. If you'd like to get in touch to get more information, then you can email us, you can telephone us, or you can visit our website, or you can contact Amanda locally in Taiwan. Thank you very much.
Thank you, Ross. So it just remains for me to say on behalf of T-Consult, I'd like to thank Ross for his presentation today and Amanda for her translation support. If you have any follow-up questions about any of the points mentioned in this webinar, then please do email them to info@tconsult-ltd.com, as you can see on the screen. We will be sending out a recording of this webinar together with a copy of the slides and our new QI agreement briefing paper, so you will receive a copy of all of those. We hope you found this webinar useful and look forward to hearing from you if we can be of any assistance with your QI compliance. So thank you for joining us today.